In this video, we'll discuss alternative forms of CAPM. Recall that standard CAPM assumes away many of the real-life phenomena such as transaction costs and taxes. Also, it considers that any transaction, howsoever small, can be done and prices are given. Investors are rational with homogeneous expectations. Short sales are allowed to the fullest extent and unlimited borrowing and lending is available at risk-free rate and all the assets are marketable. However, we know that most of these assumptions are not tenable and therefore standard version of CAPM may not be an ideal model of equilibrium. In this lesson, we discuss some of the important alternative non-standard forms of CAPM. We start the discussion by discussing the fallings of CAPM that provide the motivation to study the alternative forms. Then we assume away some of the ideal scenarios considered by CAPM. First, we consider the case with short selling restrictions. Then we discuss the no risk less lending and borrowing case. Then we move closer to reality with riskless lending but no riskless borrowing case. We conclude this discussion with differential riskless lending and borrowing case. Next, we move on to more advanced forms of non-standard CAPM. These include CAPM with personal taxes, non-marketable assets, heterogeneous expectations, non-price taking behavior, multi-period and multi-beta CAPM, and consumption CAPM. Lastly, we discuss various tests of CAPM and then we close the discussion with summary and concluding remarks. In this video, we'll provide the motivation and background to alternative versions of CAPM. Previously, we saw with the standard form of CAPM that there were certain assumptions that were further away from the real life behavior of financial markets. These assumptions help us obtain the standard version of CAPM that was very simplistic yet a powerful description of behavior of security market prices. However, some of these assumptions that we assumed away are really important. And these assumptions, if we want to understand the impact of these assumptions on prices or these factors on prices such as frictions and taxes, we need to incorporate them in the model. Not considering these factors may lead to certain fallings of CAPM that we'll discuss in this video. It appears that CAPM holds at aggregate level, but when you look at micro or individual investor level, it does not hold. These small investors hold portfolio that are different from market portfolio. Rather, they are small portfolios which are not similar to market portfolios. There are certain assumptions that are made by CAPM that tend to violate the real world conditions in a rather more obvious way. First, there are no transaction costs. That is one critical assumption. However, we know in the real market there are frictions, transaction costs, which affects prices. Next, we assume that securities are infinitely divisible. That means we can take any position, howsoever small may be, to buy or sell securities. However, that is not the case. And in financial markets, there are minimum transaction sizes that one needs to take to do the transactions. We also assume that prices are given, that is, buyers or sellers do not affect prices. However, we also know that particularly large institutional investors, they affect prices, their large transactions affect prices, and in fact, they incorporate the possible or potential impact on prices in their trades as well. It also assumes that investors are rational. However, we know many times investors behave irrationally, particularly during the crisis or periods where irrational exuberance is exhibited. We also said that unlimited short sales are allowed. However, in all the markets, there are restrictions of short sales. In some markets, these are large. In some markets, these are small. It is never that long and short positions are symmetric in any market. So you cannot freely and fully short sell any security. We also assumed unlimited lending and borrowing at risk-free rate. However, it is not the case. First and foremost, the lending rate is always lower than the borrowing rate. Second, we cannot borrow infinite amounts. Another very important assumption is of uniform expectations. It is said that all the investors define their investment period in a similar manner, and within this investment period, their expectations of risk return and correlation matrix is same. That is, the return distribution, joint distribution of returns across securities is same for all the investors which is obviously not the case. Investors have different periods of investment and consumption, and also their expectations about risk, return, and correlation metrics are different across securities, which affects their utility function in a different manner. Lastly, we assume that all the assets are marketable. That is, whatever asset is can be sold and bought in financial markets quickly and swiftly. But we know that is not the case. That is, there are assets like real estate, cattle, and land which may not be exactly marketable, and some of them, even though marketable, like land, real estate, they cannot be sold and bought immediately, maybe not in months or even sometimes years. While it is not the case that all of these assumptions need to be relaxed simultaneously and the model needs to be modified, however, some of these assumptions are really important, and particularly from policy perspective. So if you want to know the impact of these assumptions, we need to incorporate them in the model, such as taxes, frictions, and so on. And therefore, some of these really important assumptions which drive the standard model further away from the reality, they can be relaxed and alternative variants of CAPM can be derived. To summarize this video, we discussed what are the assumptions and therefore the fallings or deviations of standard version of CAPM from real life financial market behavior. And we also said that some of these assumptions are really important and therefore they need to be relaxed, and alternate variants of CAPM can be derived, which will help us study different influences like taxes and frictions on prices. In this video, we'll discuss the implications of imposing short sale restrictions on standard version of CAPM. In the standard version of CAPM, we said that unlimited short sales are allowed in the broadest of terms. That is, investor can sell any security, whether owned or not, and use the proceeds to buy or sell any other security. And this short position can be held for very large values as well as for very long durations. And with this broadest of assumption, the equilibrium and most optimum efficient frontier and market portfolio that we got was a position that was long in market portfolio. So even in the broadest sense, the dominating and best position was the market portfolio long position. Even the graphical interpretation with the help of efficient frontier and the feasibility region would suggest that even if we disallow the short sale fully, the same dominating market portfolio investment will be obtained. That is, in the standard CAPM framework, with all the broadest assumptions, no investor will sell any security short and rather hold the market portfolio in equilibrium. And therefore, this being the dominating position, even if we allow the short sale, which is like a suboptimum case, we should obtain the most dominating position, that is market portfolio. Market portfolio with no security being sold short, that is all long investment, because creating this long investment does not require shorting any security. To summarize, in this video, we noted that even if short selling restrictions are imposed, the dominating or the best portfolio, that is market portfolio, where we only needed long positions to hold that portfolio, that still remains the dominating portfolio, and therefore the revised or modified model with short selling restriction does not change from the original standard version of CAPM. That is, we still hold the same market portfolio as the best portfolio in long position. Starting from this video and in next series of videos, we'll relax the assumption pertaining to unlimited riskless or risk-free lending and borrowing. From this video, first we'll relax the assumption and assume no riskless lending and borrowing, and then in subsequent videos we'll get more step-by-step manner, more closer to reality, where we'll incorporate different riskless lending and borrowing rate and not infinite borrowings. So we start with a simple proof. At the beginning, we assumed in the standard version that an SML line or security market line should exist that defines or captures the phenomena that in financial markets only systematic risk matters. All the unsystematic risk should be diversified away, and therefore the only risk that should define the security prices is an equilibrium SML that relates security prices or returns or their expectation of security price and returns to their systematic risk, which is beta or its sensitivity to market risk. Now, even if there is no riskless rate present, still this systematic risk will only affect prices, and therefore we can put or describe this relationship in the form of a line, as we can see here, where on the x-axis we have the systematic risk beta and on the y-axis we have expected return. Since we have already proved that if there are assets that are above or below this line with arbitrage argument, all of them should fall on this line, and therefore all the assets in equilibrium, all the securities should fall on the security market line, and the market portfolio M should be a weighted average of all these securities as their actual investment in the market. So it's sort of micro depiction of what is happening in the real macro market. Now we introduce this model as zero beta or two-factor model, and we say that because this is a straight line, ultimately it has to cut at some point on the vertical axis, and we are calling that point as RZ or zero beta rate. That is, this portfolio or this security RZ bar does not have any market risk. Its beta is zero. Obviously, it will have some total risk, or its standard deviation or sigma will not be zero, but its beta is zero. And therefore, because this is a straight line, it is easy for us to define the equation of the straight line. The equation of the straight line on expected return and beta axis can be written like this, like any straight line where A is the intercept and B is the slope. So this is the new equation of new SML, security market line. And we know 2 points on this particular line. First is the RZ, which is the zero beta portfolio. If we substitute this and put the values, we know the intercept, it will turn out to be RZ bar because beta is 0 and its return is RZ bar. So the intercept B turns out to be equal to RZ bar. Next, this portfolio must also hold the market portfolio. This line, this SML line, new SML line, must also hold market portfolio, and we know the coordinates of market portfolio. Its beta is 1 and return is RM bar. Substituting these values, we get the value of B, that is slope, as RM bar minus RZ bar, and therefore our resulting expression becomes generic expression which defines any security RI bar, its expected return, and relationship with beta as Ri bar equal to Rz bar plus Rm bar minus Rz bar into beta I. This is also called zero beta or two-factor version of CAPM. This line describes the new SML, security market line, in the absence of risk-free lending and borrowing. So this is our first step towards the more realistic real market behavior. We start with assuming in absence of riskless lending and borrowing. To summarize, in this video, we derived the zero beta version of CAPM, which is our first step into real life financial market behavior, where we assumed that there is no riskless lending and borrowing. With this simple relaxation, we could obtain a very simplistic yet very powerful model, and often after first standard version, the most utilized model, zero beta version of CAPM. It appears to be very similar to the original CAPM, only that instead of RF, it includes RZ bar, which is the zero beta portfolio or zero beta security, which has a beta of 0, but some overall risk, which is idiosyncratic, diversifiable risk. Recall a rigorous derivation of CAPM, the standard version of CAPM, where using the theta slope maximization method and the equations that we saw earlier, we could derive the CAPM in a more mathematically rigorous manner. We'll use the same approach for the zero beta version of CAPM, using the same set of equations to maximize the slope theta and get the zero beta version of CAPM. In this case, we'll have no riskless lending and borrowing, so we'll be talking about zero beta version of CAPM. Assume that there is a R-F kind of rate available at which if investors can lend and borrow unlimited amount of money, they will hold market portfolio. So let's say if you observe some market portfolio, there's a particular rate at which this market portfolio is held if they can lend and borrow infinite amounts of money at this rate. So what is the connection between this portfolio and market? If I drop a tangent, essentially it's the same analysis that we had earlier. If I drop a tangent from this rate at market portfolio, I'll get the market portfolio. Sort of tangency point is obtained at this particular rate. But please note, this is not a risk-free rate. This is some rate at which if investors can lend and borrow unlimited infinite amount of money, they will hold a market portfolio. The tangency portfolio will be market portfolio at this rate. Now, if such portfolio exists, if there is some portfolio like this, we can obtain the optimum security proportions. So for example, I can find the optimum security proportions in this with all the analysis that we have discussed earlier, and security and system of equations, solving those and system of equations and unknowns x1, x2 and so on xn. So we can obtain the optimum proportions with that all theta maximization procedure, that was maximizing this d theta upon dxi, setting it all the partial differentials equal to 0, that is d theta upon dxi equal to 0 for all I equal to 1, 2 and till n. So we can employ them and obtain, recall we could have obtained this set of equations where r dash f was that variable at which infinite lending and borrowing would lead to holding of market portfolio. But recall, we also noted that the covariance expression between in the real market, the covariant expression between any security and market portfolio was like this. This was our derivation for CAPM, where we said this is the expression for any security with the real market portfolio, real market capitalization. Then we have these two equations to compare, and in the CAPM analysis we said that this portfolio, this tangency portfolio is the same, that is this tangency portfolio that we are trying to obtain with this r dash f has the same composition as the actual market, that is this in this expression this x1 is same as this x1. Recall we earlier had this notation x1 dash x2 dash x dash and so on, but now we are saying both of them are same. So in that case I can write a simple expression that this LHS side I can equate to get rj bar minus r dash f upon lambda equal to this, and this analysis led us to this version. So basically we made use of one portfolio which is market portfolio, so based on which we got the value of lambda, which was sort of covariance of rj comma lambda was covariance of rj comma rm upon sigma square m, and this we call as beta. So we got the value of beta as this expression covariance of rj comma rm upon sigma square m, and then we replace this to got the 0 beta version of CAPM. But please recall we said that r dash f is not the risk-free or riskless rate. So it is that rate where investors have unlimited lending and borrowing available, they will hold the market portfolio. It is that rate, but not risk-free. Its only key property that we can establish that it has no covariance or correlation with market. That means its beta is 0. That is the only property we hold, but it's not the purely riskless asset. It must have some variance, some standard deviation, only that its beta is 0. And therefore, let's say if this r dash f were to exist here, so the feasible set of portfolio that can give you r dash f are these, but out of all these portfolios, you would choose the one with the minimum risk, which is this. So this Z or minimum beta portfolio will have a return of RZ bar, expected return of RZ bar. This is the portfolio with the least amount of risk across all the portfolios, having this r dash f expected return, r dash f bar, which will lead to the tangency portfolio as market portfolio. So now this portfolio we are designating as Z, and its expected return RZ bar as r dash f, what we found here. So our new equation that we saw earlier converges to rj bar equal to rz bar plus beta j into rm minus rz. So it's very identical to the original standard version of CAPM, only that instead of rf you have replaced with rz bar. So rf used to be the very pure risk-free rate, but here rz bar is not exactly purely riskless. It is that portfolio which has zero correlation with the market, but it has indeed some risk. Across the class of r dash f return, this has the minimum risk, but still it has some risk or standard deviation. To summarize, in this video, we discussed the more mathematically rigorous version of proof of zero beta version of CAPM. We note that it's very similar to the standard version of CAPM, only with the replacement that now, because we do not have any RF, we have RZ bar, the zero beta portfolio. And the interpretation of this RZ bar or zero beta portfolio is as follows. It does not have any correlation with the hypothesized or the observed market portfolio, but it indeed had some risk, some standard deviation across all the portfolios in the feasible region with the expected return of r dash f or rz bar. It is the one with the lowest risk. Now that we have derived the security market line and equation for zero beta CAPM, let us try to understand this zero beta portfolio and its position vis-a-vis market portfolio and minimum variance portfolio. Recall the equation for this zero beta model Rj bar equal to Rz bar plus beta j plus Rm bar minus Rz bar, where Rj bar is the expected return on security j, Rz bar is the expected return on zero beta portfolio, beta j is beta of security j, Rm bar is the expected return on market. We said that the zero beta portfolio for expected return Rz bar is the portfolio in a set of portfolios that offer this return, the portfolio with the minimum risk. So it is here on the minimum variance frontier. Why on minimum variance frontier? Because we choose this portfolio such that it offers the lowest risk for a given level of return, which is Rz bar. And also this portfolio by very design has no correlation with the market. That is, we are saying that correlation between zero beta portfolio and market is zero, or the covariance between them is zero. Let's call the risk of this portfolio as sigma z. Now let's suppose on minimum variance frontier. What is minimum variance frontier? Minimum variance frontier is on this portfolio feasibility region. This is the portfolio feasibility region. Here on this convex kind of nature, the surface of this convex nature comprises the portfolios that offer minimum risk for a given level of return. For example, if I look at this level of return, what is the minimum risk? This point. Similarly, for this risk return, this point. So for every level of expected return, the set of portfolios that offer minimum risk are on this surface, on this convex surface. This is called minimum variance frontier. On this minimum variance frontier, there is a particular portfolio that offers the lowest risk, which is called the minimum variance portfolio, and we are interested in knowing the composition of this portfolio, its position vis-a-vis market portfolio and portfolio Z. And we said that wherever this Z may stand, a combination of this Z and M, because both of them are on this minimum variance portfolio, there must be a unique combination of this portfolio Z, investment in Z, and M available, that would give us this minimum variance portfolio S. And by this logic, let's assume that investment proportion is XZ in portfolio Z and 1 minus X, therefore XZ in portfolio market portfolio, that offers us this sigma S. And therefore, if you recall our formula, x1 square sigma 1 square, the risk of a portfolio with investment in security 1 and 2 is x1 square sigma square plus x2 square sigma 2 square plus 2 times sigma 1 sigma 2 x1 x2 into rho 1 2. But we know that this portfolio does not have any sort of correlation with market, which means we can say that this between market and portfolio Z, rho 1 Z is rho Z M 0, and therefore we are left with only two terms, which is corresponding to x1 square sigma 1 square plus x2 square sigma 2 square. In this case, x1 we are calling it xz, and therefore the remaining part 1 minus xz is invested in the market. So this equation, we'll try to find the minimum of this equation. To minimize this, we set the first derivative, which is d sigma s square upon dxz equal to 0, which will be 2xz sigma xz square minus 2 sigma m square plus 2xz sigma m square. There, the covariance or correlation term is 0 because there is no correlation or covariance between zero beta portfolio and market. Now, if we solve for this equation for minima, we'll get this expression for xz. If we solve for double differential for minima to take place, that has to be positive. We can cross check that. Notice here differential, if we further differentiate this expression with respect to xz, it will be positive. But rather than doing that, let's focus on this xz. The numerator and denominator of this function are positive, and therefore xz must be a positive entity, which also means that, and also it would be less than 1. So for example, this xz would be something like 0.4 or 0.6 or 0.5, which is between 0 and 1. By very design of this formula, xz will be somewhere between 0 to 1. And therefore 1 minus xz will also be somewhere between 0 to 1. What is the implication for our minimum variance portfolio S then? Because S requires some kind of positive fractional investment in Z as well as positive fractional investment in 1, it is necessary that S will lie somewhere in between M and Z. which means it, as it appears on this diagram, S will be somewhere M and Z. Now we have proved it. Earlier it was just an hypothesis. It was appearing in diagram, but we were not sure. But now we have just proved it, that minimum variance portfolio S will lie somewhere between M and Z, because XZ is a positive fraction. And therefore also, since it is a minimum variance portfolio, it will be slightly above Z, on the right side of Z, and because it is a minimum variance portfolio, it will be on the upper side. And Z will lie below S, on the left side rather. And that is why we also know that on this minimum variance frontier, only those portfolios that are above S are efficient. On the minimum variance portfolio, only those portfolios that are above S are efficient, because Z is below S, it is inefficient. Which also means that it offers a higher risk. That portfolio offers a higher risk than minimum variance portfolio, and therefore no investor will hold this portfolio alone. They will hold this portfolio Z in combination with portfolio M. They will hold this Z in combination with M in a manner that the combination lies either on S or above S. So for example, all those combinations will lie here, S to M. So if they invest partially in Z and partially in M in a manner that their portfolio positions will lie on the S, right to the S. There would also be some of them who will short Z and put their money further amount in M, so that their position will be on the right side of M on this segment. So eventually we'll end up with a segment SMC, where S to M will be set of risky portfolios, which are combination of long Z, long M, while those that are shorting M and investing not only their own wealth but further on M, they will be on this MC and so on. Because we said that this portfolio Z is an inefficient portfolio, the aggregate holdings of Z will be 0. That means on aggregate, investors will only hold this market portfolio. However, individual investors may hold Z along with them in a combination such that the resulting portfolio will lie on the efficient frontier. On overall, individual investors only hold the portfolio Z and portfolio M, so that it becomes again two mutual fund theorem or two fund theorem. Why? Because there are two portfolios or funds that are held, which is M and Z. So we call zero beta portfolio or zero beta model also as a part of two fund theorem or two mutual fund theorem. To summarize, in this video we saw some of the properties of the zero beta portfolio Z. We noted that it is one of the minimum risk portfolios that offer expected return of RZ bar. Also, that this portfolio is inefficient and it lies on the left of the minimum variance portfolio S. In order to get the minimum variance portfolio, one has to invest up some positive amount in Z and some positive amount in market portfolio M. And therefore, the efficient frontier SMC is constructed by investors by investing either going long or short in Z and investing their remaining money in portfolio M. On the aggregate, because Z is inefficient, no investor will hold this portfolio Z on aggregate, while individually they may hold, but on aggregate they will only hold M. In this video, we'll take one step ahead towards a more realistic case from one extreme of no riskless lending and borrowing, and we'll say riskless lending but no riskless borrowing. Often this is a more realistic case to assume that investors can risklessly lend a lot of money, which is essentially investing in like government securities, and the fact that the interest rate that is offered on same security will remain same for all the investors no matter how much money they spend, also contribute to the assumption that infinite amounts of lending in a riskless manner. Then the following changes will happen to our efficient frontier. First and foremost, given that risk-free lending rate RF, I can get this tangent portfolio T from the risk-free lending rate RF. Also, the tangent from market M will end up at RZ bar and we can obtain the zero beta portfolio Z. Now please note, as we'll see later, M will be on the right side or higher to the tangent T, and therefore RZ bar will be higher than RF. So now we have the positions for the tangency portfolio on the risk-free lending rate as well as the zero beta portfolio Z and market portfolio. Originally, when this risk-free lending rate was not available, SMC was the set of efficient portfolios. However, now if you compare the segment TS, it is dominated by portfolios on RFT. That means if I want if I want as investor the risk corresponding to this TS segment, I can rather invest on RF to 2C. So the positions on RF to T dominate the positions on S to T. So instead of ST segment, the new efficient portfolio segment is from RF to T. Moreover, those investors who wants to take a slightly higher risk than T, they can also invest on TMC as efficient portfolios, and therefore our new efficient frontier is not unlike STMC or SMC earlier. Our new efficient set of portfolios are RF to T and then TMC curvature. So RF to T straight line and TMC curvature. Now here we'll see, even if one single investor wants to invest on TMC, that means portfolio that offer higher return than T and therefore slightly higher risk, even one investor is on the right of T, the market portfolio, which is combination of all the set of portfolios, will lie to the right of portfolio T, which is on here, and therefore the tangent will be higher than point RF, that is RZ bar will be higher than RF. So now effectively we realize that our efficient segment is RF to set of T. What are these RF to T portfolios? These are portfolios where some amount is invested in RF and some amount is invested in T. And beyond T we have TMC. TMC is a set of portfolios that are combination of portfolio Z and portfolio M, that is purely risky portfolios. So TMC efficient frontier, part of efficient frontier, is only set of risky portfolios, while RF to T is part of portfolios where some combination of risk-free and risky portfolio T. Even T is obtained as a combination of M and Z. So again, to reiterate, the efficient segment RF to T, which is a line segment, which is an investment on risk-free and risky asset T. RF is the risk-free asset at which we can lend infinite amounts. T is the risky asset, which is a combination of M and Z. Beyond T, that is TMC efficient segment, is only combination of risky assets, that is M and Z. To obtain a position from T to M, all we need to do is put long in Z and some amount long in M, while beyond M we need to short some money in Z and invest not only our own wealth, original wealth in M, but also the received money after shorting Z in M to obtain a position on this MC and beyond. So essentially everybody holds three portfolios, RF, M and Z. So this is also called three mutual fund or three fund theorem, defining our zero beta model. So this new model will have three funds: investment in market portfolio, zero beta portfolio, and riskless asset. Also that because Z is an inefficient portfolio, it's not efficient because it is below S. On aggregate, there will be no investment in Z. So all the investments that are in Z are in combination, some combination with maybe M and so on. And therefore, if we aggregate all the positions, the net investment in Z will be zero. Now, there's one interesting finding here. Till now, we have been saying that any combination of efficient portfolio are supposed to be efficient. However, in this unique case, a set of efficient portfolios that lie on RF to T and their combination, so we obtain these RF to T by investing partially in RF and partially in T. Any combination with the segment on TMC will be inefficient. For example, if I combine RFT and portfolio M, the combination will be inefficient. As you can see, this will be dominated by TM, and therefore this is a unique case where the set of efficient portfolios, their combinations are not necessarily efficient. To summarize, in this video we saw that when riskless lending at infinitely available at risk-free rates, then we have the efficient set of portfolios represented through a line segment RF to T from risk-free lending rate to a risky asset T, and then a set of risky portfolios on curvature TMC. Also, in equilibrium, the investors hold three portfolios, that is RF, risk-free, a portfolio M, and zero beta portfolio. Therefore, it is also called three fund portfolio or three mutual fund theorem. In the previous video, we discussed efficient portfolios and construction of capital market line. The capital market line holds only efficient set of portfolios. So now in this video, we'll introduce security market line, which carries all the securities, including efficient set of portfolios as well. The dynamics on expected return and beta, which is the systematic risk, appears like this. And the portfolio RZ, which is here, it was above RF, so it is here, its location. T the tangent portfolio, market portfolio M. Now, we already said that market portfolio remains the efficient portfolio. Market portfolio was efficient, as we already saw, and the expected return on all the securities at equilibrium can be described in the form of market portfolio by this security market line, or sort of revised 0 beta CAPM for this case, where infinite or very large riskless lending is allowed, which is Rj bar equal to Rz bar plus beta j Rm bar minus Rz bar, which is very similar to the previous case that we saw earlier without riskless lending and borrowing, only that now this line describes these set of securities that are only risky securities. These are securities that are combination of 0 beta security and market. All the securities including T and C and all the other securities on this line segment, these are risky securities that make for portfolio, market portfolio and 0 beta portfolio. So this line segment, security market line or 0 beta equation, CAPM 0 beta version equation, RZTMC describes only risky securities. However, as we noted, there are also investors who may be investing in this RF, risk-free asset, but for them, the efficient set of portfolios, we noted that this RFT is efficient set of portfolios combining RF, some money in RF risk-free instrument and some money in this risky portfolio T, which is essentially a combination of 0 beta and M. Now there is a slight discrepancy here in the sense that the efficient portfolios are described by this line RF to T and then TMC, but security market line essentially is the description of RZTMC. Segment RF to T only describes those investors that hold some part of money in the risk-free securities RF. This also means that there are a set of securities where efficient securities on RFT offer a lower return than RZT. But this is intuitive also, because the securities RZ to T, they are not they may be risk-free in terms of the relationship with market, but they are not necessarily risk-free in overall terms. That means they must have some standard deviation. So this 0 beta portfolio RZ must have some standard deviation, although it's beta, the risk with market may be 0, but overall risk, there must be some overall risk. In practical terms, think of gold mining company, which may have a very low market risk, but it have overall large risk or large standard deviation depending upon its ability to find gold. So its fortunes will be tied up to mining gold and ability to discover gold mines. So here we saw that there are some of the efficient portfolios that are on the line RFT, which offer lower return, and probably this is ascribed to the fact that they have lower standard deviation than portfolio on RZ to T. It is also important to note that this kind of model allows investors to hold various kinds of other securities that are not same as market. So in addition to market, various other security portfolios such as RZ 0 beta portfolio is also allowed to be held. To summarize, in this video we discussed the security market line SML line behavior for the 0 beta version of CAPM, where infinite risk-free lending is allowed, but risk-free borrowing is not allowed. We saw that in this case, the SML appears to be this RZTMC line, which is very similar to the case where there was no risk-free instrument available. But in this case, this line only describes the behavior of risky securities. The risk-free securities, though efficient, they lie on RFT segment. They are efficient, but still they offer a lower return, and they are not described by the behavior of SML. Our discussion on risk-free instrument will culminate in this video. Here, we'll discuss differential risk-free lending and borrowing rate, which is a very practical case. Generally, whenever we lend or invest money in risk-free securities, it is often at a lower rate than the rate at which we borrow. The borrowing rates are often higher, and borrowing is generally considered as risk-free because from the borrower's perspective, the borrowing, whatever amount it is almost risk-free. It is from the lender's perspective where we think of the risk of default. So in this video, we'll talk about security market line from the perspective where differential risk-free lending and borrowing is allowed. The discussion we can heavily draw from the previous case and is very similar. For example, let's say we have a risk-free lending rate L and the tangent to the efficient frontier is at point L. Similarly, the risk-free borrowing rate is B and tangent to the efficient frontier is at B. The 0 beta portfolio RZ bar, the tangent is drawn to the market portfolio. Now, It is easy to understand why market portfolio should lie on the efficient frontier between L and B. First and foremost, this market portfolio is the combination of all the risky securities in the market. As we can see in this diagram, the only set of risky securities that are taken by investors are from L to B. These are the efficient securities. They lie on the efficient frontier, and these are the only risky securities in the market. And therefore, the combinations of L and B, any combination on this can be obtained as a combination of L and B. So any security on this LB frontier can be obtained as a combination of L and B. And therefore, the market portfolio, which is the weighted average of all these securities, will also be some combination of L and B, and therefore it should lie in between B and L and on this efficient segment, that is LB. So market is an efficient portfolio and its position can be also identified, which will remain between the tangency point L and B. Now that we are able to identify an efficient market portfolio, we can also find the equation of security market line on the zero beta version of CAPM for this particular case, which is also very similar to the previous case, that is RJ bar equal to RZ bar plus beta J times RM bar minus RZ bar. Now this particular equation defines the price and return behavior, expected return behavior of securities on expected return and beta axis for the set of securities that lie between L and B. So for only these set of, this line will describe the behavior of only these set of securities between expected return and systematic risk, that is beta. There will be other securities that are part of this efficient securities from RL to L and beyond B, this segment beyond B, which is the borrowing segment, and RL to L. So RL to L you can construct by investing some amount in money in R and some amount in L. L is essentially a combination, this tangency portfolio L is essentially a combination of zero beta portfolio and M, where we are investing some amount in zero beta portfolio and some amount in market portfolio. There is also another set of securities from B, tangency point B and beyond, which is basically borrowing at the borrowing risk-free rate available RB bar and investing the money, the own wealth and borrowed amount in B to get this position on the efficient frontier. These two segments are not described by this zero beta version of CAPM. The only portfolios that are in between, and in between also the portfolios from L to M, LM segment is constructed by investing some amount in zero beta and some amount in M. While that bit from M to B, MB segment is obtained by borrowing at zero beta, investing own wealth and borrowed amount in M to obtain portfolios from M to B. Please note here also that this zero beta portfolio is an inefficient portfolio, and therefore on aggregate investment in zero beta will be zero and it will be only taken in risky these LMB segment as a combination with market portfolio. So whether you want to construct portfolio L or B or somewhere in between, you need market portfolio and you need to identify the zero beta portfolio. Using all these two portfolios, M and L, you can identify all the risky securities. Then you can use either only risky securities, or you can mix with them with the risk-free rate to obtain any of the efficient securities available here. But the zero beta CAPM version that you see here only describes risky securities, risky set of securities that lie from L to B. To summarize, in this video, we saw the set of efficient securities in the present of different risk-free lending and borrowing rate. We found that these will be segment RL to L, and which includes risky and risky security investments, then L to B, LMB, which is only risky securities, and then beyond B, the straight line, which is the combination of borrowing at risk-free rate, borrowing rate, and the tangency point B. So this is our efficient segment. We also noted that here also we can obtain some kind of zero beta version CAPM, but that describes the behavior of only risky securities from LMB segment on LMB line, LMB curvature segment, and not those where risk-free securities are also involved. So only risky securities can be defined by the zero beta CAPM version. In the standard version of CAPM, we ignored taxes. However, we know taxes do play a very important part in investors' decision making. For example, different instruments are taxed at differential rates, and therefore the net income to investors may differ, and the choice of investor may accordingly vary across instrument to instrument depending upon the tax rates. So in this video, we'll discuss the application of taxes or the introduction of taxes in the form of alternate version of CAPM model. Let's start with discussion about CAPM ignoring or relaxing the assumption of taxes. With this assumption, investors in the theoretical model appear to be indifferent to receiving income from capital gains and taxes, because in general across the world capital gains are taxed less heavily than dividends. Dividend income like interest, they are taxed more heavily than capital gains. And real life examples do suggest that when capital gains are taxed at lower rates as compared to dividend, this affects equilibrium prices, because even if we take the assumption of homogeneous expectations, that means expectation of pre-tax rates may be same given the risk of instruments, investors do focus or judge the returns after taxes. And therefore, when we incorporate this taxation component, the equilibrium relationship changes, and it appears to be as follows. It is indeed necessary that we obtain the equilibrium relationship, because markets do clear and we do find equilibrium prices even in the presence of taxes. So let's discuss this equation or the revised model. There are certain terms in this model that we already know, such as expected return on security I, risk-free rate, beta of the security, expected return on market. However, there are certain new terms are also introduced. For example, delta M. This delta M is the dividend yield on market portfolio. Delta is the dividend yield on stock I. Tau is some kind of complex weight of different tax rates, and it sort of reflects the differential across capital gains and other incomes such as dividend yield, taxes on dividend, and interest. Generally, capital gains are taxed at lower rate than dividend income, and that higher, because of that differential higher tax imposed on dividend income and other forms of income than capital gains, this tau remains positive. So this tau is positive, reflecting the differential taxes, a higher level of taxes on dividend as compared to capital gains. It's a positive number. Now, to build the intuition, expected return as per this formula are an increasing function of dividend yields, delta. This is to suggest that a higher dividend yield reflects that a large fraction of returns are paid in the form of dividends. Then investors also have to pay a higher level of taxes, and therefore the component that goes away from the investor in the form of taxes is large, and they may expect higher returns. So they may expect higher returns when dividend yield is high. Also, there is RF, which is the risk-free rate, which goes with a negative sign. There are two ways to think of this negative sign. First, essentially it is the opportunity cost of investing in stocks. For example, if I would not have invested in the stock, I would have invested in some risk-free instrument, deposited money in some low-risk instruments, and got this amount. So essentially this is the opportunity cost that I'm losing when I'm investing in stock. The second way to think of this RF with a negative sign is to think of converting my dividend paying stock into capital gain stock. That is, for example, I can borrow a certain amount, which in the sense is equal, that I purchase a stock and the dividend from this stock is paying the interest on borrowed capital. So essentially the interest on the borrowed capital is paid by the dividend payment. So I nullify my dividend payment, and essentially I convert my dividend paying stock into capital gain stock by investing through borrowed capital. So that way also you can think about the negative sign of RF. So now the new version of CAPM, this new version after incorporating dividend yield, let us compare with the original CAPM. There is a new variable which is called dividend yield delta I. The new equilibrium is described in a three-dimensional space of Ri, beta I, and delta I. Unlike earlier, the original standard version of CAPM was described in two-dimensional plane where x-axis was beta I, the risk, and Ri, expected return, Ri bar, was on y-axis. So instead of that two-dimensional space, now we have three-dimensional plane, which is Ri, expected return, beta I, risk, and delta I, dividend yield. So let's say if we fix the beta for a given beta, the expected return will go up as the dividend yield rises. And similarly, for a given yield, the expected return will go up as the beta goes up. So one can derive and find a set of efficient and optimal portfolios as a function of tax rates on dividends, capital gains, and interest income. That means now our single optimum, that optimum market portfolio, can also be obtained in the form of different tax rate. Depending upon tax rates, one can obtain a different optimum portfolio. So for example, if an individual is taxed at a different rate, for them a different set of optimum portfolios exist as compared to another set of investors that are taxed at another set of rates. Let's discuss the implication of this new model on real life investors. So in general, the investor who is in a low marginal tax bracket will prefer high dividend paying stocks, and therefore in his optimum portfolio the proportion of high dividend paying stocks will be higher as compared to the percentage of these stocks in the average market portfolio. Why? Because the disadvantage of these high dividend paying stocks in terms of taxation, that is a disadvantage in terms of taxation of dividends, is relatively less as compared to other average investor or investor that is in high marginal tax bracket. So this investor who is in low marginal tax bracket may have a higher proportion of high dividend paying stocks in his optimum portfolio, because the disadvantage, or rather these highly taxed high dividend paying stocks that are highly taxed are slightly relatively less harmful to other higher marginal tax bracket or average marginal tax bracket investor. Vice versa analysis we can apply for investors in high marginal tax bracket, that is they would prefer low dividend paying stocks, because these stocks, even though there is a disadvantage in terms of low dividend payment, but because of low tax incidence, these stocks are slightly more beneficial, relatively more beneficial as compared to average or low marginal tax bracket investor. To summarize, in this video we introduced personal taxes in our standard version CAPM. We relaxed the assumption that there are no taxes and we introduced the presence of taxes, and we discussed the new model, the implication for the model, and we found that with high dividend yield, because the incidence of tax is higher, a different model will appear which will reflect this fact that the differential in taxation on capital gains vis-a-vis dividend yield would create different set of clienteles, different buckets, clientele with different tax buckets, and the behavior of investors who are in high tax bracket, high marginal tax bracket would be different as compared to investor in the low marginal tax bracket.